Start that.
Okay, so I'll go ahead and call this meeting to order of the Silicon Valley Clean Energy Finance and Administration's Committee special meeting of Monday, November 29th. A few things I'll just note is this meeting will be conducted in accordance with the California Government Code Section 54953 in consideration of the coronavirus. All members of the Silicon Valley Energy Executive Committee and staff will participate in this meeting by teleconference. Members of the public may observe this meeting electronically by accessing it via Zoom. If you're observing it, clearly you've figured that out. You can also submit public comments in advance in the future. The public may also provide comments on matters listed on the agenda. Speakers are customarily limited to 3 minutes each. However, the committee chair, myself, can increase or decrease the time if we have a lot of speakers. So at this time, I will ask the clerk if you could do a roll call for me.
Yes, thank you, Chair. Chair Rennie.
Here.
Vice Chair Mikachuk. Vice Chair. Director Gibbons. Here. Director Klein.
Here.
Director Martinez Beltran. Okay, so it's noted that.
Sorry, did you hear me say present?
I did not, but I knew you were here. Okay. So it's noted that Vice Chair Mikachuk is present and that Director Martinez Beltran is absent at the time of roll call.
All right, so at this time, I will start to see if anybody would like to make comments for items that are not on today's agenda. And I don't see any hands being raised from our attendees. So I will close the verbal communication for items not on the agenda and move to we have no consent calendar today. So I'll move to our regular calendar, which is to consider and possibly recommend to the Silicon Valley Board changes to our Silicon Valley clean energy rates for our revised FY 2022 budget. And our Chief Financial Officer and Director of Administrative Services, Amrit Singh, will do the presentation. So I will turn it over to him. Thank you.
Excellent. Thank you, Chair. So yeah, we're gonna look at the new proposal to change our SVCE rates, given that PG&E filed their ERA update. So if you remember, when we set the budget, we were basing the budget at that time based on a forecast of what the PCIA and PG&E's generation rates would be. Now we have updated information based on the November 8th filing that PG&E made that significantly changes the budget projections. So I'm going to walk you through the budget projections. And Kevin, if you could go to the next slide. So I'll walk you through the timeline of when we set the budget and what considerations went into effect at that time and what decisions we have to make now to have rates in effect in January. We'll revisit our margins and how our margins look like in light of the new PCIA rates and PG&E's generation rates, what its impact is on the budget. We'll also talk about the risk factors that we should consider as we interpret the results of the new margin numbers and future risks that may materialize in the future. We'll talk about price forecasts. Forecast is very important in how we shape and develop our budget and the margin numbers. We'll talk about how the source of the data and could that data be improved. We'll also talk about stress testing. What if a condition adverse to what we're projecting were to occur? What we usually call extreme scenarios, tail events, also known as black swan events. If those were to occur, how could we withstand such a shock to our organization? Then, based on the improved margin numbers, we'll talk about, well, how should we use additional funds? Should we be keeping that in our reserves of future black swan events? Should we consider some other options such as increasing customer discount or in funding for decarbonization programs. We look at the impact on the reserve analysis, what we staff are recommending and what the executive committee, when they met, recommended. And we also look at a revised budget, and I'll talk about that when we get to that slide. And then we'll ask you for your recommendation for that the board should consider at next week's December 8th meeting. Okay, so that's the agenda for today, and let's start with the timeline on the next slide. So around this time last year, we were providing a 4% discount. And then in December of last year, the board voted to reduce the discount to 1% of PG&E's generation rates because of the large increase in PCIA and decreases in PG&E's generation rate. And then so those rates went into effect January 2021. Then in March 2020, there was another rate change, and that was because of additional increase in PCIA and a slight increase in PG&E's generation rate. Then what happened is when we set our budget that the board adopted in September and that we reviewed with the finance committee early in August and with the executive committee in June, we were projecting a very good year for the next fiscal year. And that was based on anticipated decreases in PCIA and increases in PG&E's generation rates. But we knew that those were based on forecast numbers, and we did not make any changes to our customer discount or additional spending. And we said the board will reconsider those in December when there's more certainty on those rates. And that's where we are today. And as I mentioned, in November, earlier this month on the 17th, the executive committee met. They reviewed staff's recommendation and the new updated budget projections and margin numbers, and they reached a consensus to spend an additional $20 million from the fiscal 2022 budget. In terms of how to allocate the funds between programs and customer discount, they decided to have that discussion at the board meeting. So today we're reviewing the same recommendations, same set of data with the finance and administration committee. We will incorporate whatever the committee recommends. We'll present that to the board at next week's meeting, and then hopefully the new rates will go into effect in January, most likely January 1, provided things, the PUC acts as we're expecting them to act. Any questions on the timeline or anything?
Brian has one. Go ahead, Brian.
I don't have a question on the timeline per se. I just wanted to note that Mike Mayer joined the meeting at this time.
Thank you. Welcome, Mike, and thanks for making yourself available in short notice. Appreciate that. We'll go to the next slide. So here we're showing you what the new margins look like. And this is relative to the assumptions that were made at the time we set the budget. And the data was as of July, and the budget again was approved in September. At that time, we expected PG&E's generation rate to increase to 12 cents and PCIA to decrease to 2.43 cents. But now we're expecting actually the PCIA based on the filing that PG&E made on November 8th, on an average for our customer group to be about 1.124 cents a kilowatt hour, and PG&E's generation rates to increase significantly to close to 15 cents a kilowatt hour. So relative to the budget, that improves our margin by about 44%. Again, these rates are still based on what PG&E has proposed to the CPUC. We don't know what action the CPUC will take. The data here is assuming the PUC approves them, but we won't know that until the PUC acts on that at their December 16th meeting. So that's when we will know what the actual rates will be in effect. Okay. And if anyone has questions, just speak up because I can't see all the members on my screen.
I'm watching for hands. I'll let you know.
Great, thank you, Rob. Next slide, Kevin. So how does these numbers translate in terms of our budget? The very first column is the budget that the board approved, where we were expecting about 36.5 million contribution to reserves. The current estimate, without taking the update in the ERA forecast update, is actually down to close to 24 million. And the reason for that is about a $20 million increase in our power supply cost. And that's because of large run-up in power prices. These are the same run-up that's actually helping us on the PCIA and PG&E generation side. So there, it's driving down the PCIA rates, driving up PG&E's generation rate, but obviously in our power supply purchases, the costs go up. With the revised margin and the revised power supply cost, we're now projecting to contribute to reserves about 109 million, provided we don't, we stay with the budgeted expenditure. So that's about a $72.5 million increase relative to the board approved budget in September. Okay, I see Brian has a hand up.
Yes, thank you. What I don't see in there is a breakout of the impact of the PCIA. That would kind of be helpful. Where would that sit and how much is it in that 72,590?
The PCIA is by far the largest chunk. I don't have it broken out. The impact is shown in the revenues in the 434 million. So that has both the increase in PG&E's generation rate as well as PCIA.
Okay, thank you.
Yeah. Next slide, Kevin. So as we look at the new revised margins, there are certain risks we should keep in our mind. The higher margins are a result of extreme run-up in power market prices. And this is what we would call in the risk term, a tail event, in the tail end of the distribution, or what we call in the risk terminology, a black swan event. So a lot of this is based on what is projected, what is projected to be the PCIA based on where the power market prices are trading today. So based on today's forecast, and part of it is also based on under recovery of PG&E's error account. So in other words, PG&E's customers were paying rates that were lower than what PG&E's cost was because of the run-up in power prices. So now PG&E's they put all that tracking into a balancing account. And come 2023, they're saying, well, I need to recover that in rates. Part of that is reflective of what's 2021 event. They're going in 2022 and saying, give me that money that I paid on the PG&E shareholders or PG&E's paid in essence on behalf of the customer. Now they'll be collecting that in rates. So one thing we should note, the black swan event in our 5-year history, so this is a really big, significant impact, and it happened to be working in the way that it's helping us. But we could easily have a black swan event that can adversely affect us in the future. And that can pull substantial amount of funds from our reserves or lead to us raising rates to make our budget balance, customer rates to uncompetitive levels, something that we obviously don't want to do. So that's something we need to think about, future black swan events that may not be favorable to us. And we'll talk about that and we try to model that by creating a stress test scenario. And as I mentioned, the PCIA is based on the current estimate market price of benchmark. Market price benchmark that the CPUC calculates based on where the prices for power to be delivered in 2022 is trading as of now, or as of the time earlier this month when they came up with the market price benchmark. If the realized prices are lower, then the PCIA will be under collected, and then under collection basically mean PCI rates would have to increase in 2023. So you've got to remember, this is not money necessarily in the bank. It's based on a forecast.
And Amrit, if I could make sure I understand correctly and share if it is correct. So we've kind of are looking at let's call it a white swan event for this current year, where everything's getting reversed from an over estimation. Basically, your PCIA is dropping because it was over collected last year because prices came up that we didn't expect. Last year's budget, we actually lost money, so it was kind of a black swan event, gray swan event, not quite all the way black from the year before. So I think the point you're trying to make is we can't really just think in a single year. We have to think across a couple years because there's lag in the PCIA as prices jump around quite a bit. Is that all correct?
Perfect. Those are excellent points. Yes. Any other questions? Okay, we'll go to the next slide. So here we look at what's really happened to the prices. You can see the the left side, we're calling it a past forecast, but I want to explain that it's not really a model-based forecast. It's where the market was trading for power to be delivered in 2022. So for example, a year ago, 12 months ago, prices were trading somewhere around $34 a megawatt hour for power to be delivered in 2022. Because of our hedging program, we bought power at that price, as there were willing sellers selling at that price. They didn't have perfect foresight to say, I'll wait until prices get to 67, then I'll sell. That was the best information the market had. That's what the market was trading at the time. Today, the power is trading somewhere around $67. Twice as much as where it was just relatively few short months ago. So that's the extreme run up in prices. And we have seen these type of trends before in a commodity business. For example, and there are many examples. There's the 2001 California energy crisis when prices went up significantly. And more recently, around the financial crisis time, around 2008, if you remember, oil was trading at $100 a barrel. Natural gas, which is very correlated to oil, was trading over $12 an MMBTU. And shortly, financial crisis hit. Within relatively less than 6 months or so, that price went in half, from around $12 to $6 an MMBTU, and electricity prices tanked accordingly. So what we're projecting, the next slide we'll talk about stress case, is not, while it's a tail event from where we're sitting today, it's not something that the market has not done in the past. It's done it a few times in the commodity business. We modeled it, the stress test for 2023, but I'm not saying it's going to happen in 2023. You can think of that. It may happen sometime in our near future. And we want to be ready for that. It could happen in 2023, but it could happen in a future year as well. So think of that. So what we did on the right side is we said, let's do a stress test, which we'll talk about in the next slides, where prices go back to the levels they were trading at for 2022, and also for 2023, prices also drop to close to what we're calling the 1 percentile tail. In other words, we model prices, we build out a distribution based on the volatility we see in the market, and we can look at the 1 percentile of the tail and see where prices are. And that's about where the 1% is where the 50 percentile was about 12 months ago. Any question on these points? Okay, so we'll go to the next slide. Okay, so the stress test we did, again, what if prices were to drop to the historical lows where we've seen them? So first column, and we stressed it for the full calendar year 2023, so that we get the full impact of the stress as opposed to our fiscal year. So again, we're looking at calendar year 2023. The first column says on an expected basis, based on where the market prices are today, and we model the PCIA and PG&E's generation rate using Cal CCA's new gen model, which is a fairly good model, as has proven to be not perfect, because no one can model PCIA and generation rate perfectly, because they can only use publicly available information. We don't know PG&E's exact portfolio. These are black boxes to us. So anyways, using current projections, we, on an expected basis, saying 2023, we can make about another $109 million. But if the stress test event were to occur, we can, instead of putting 109 million towards our reserves, we could be pulling 156 million to somewhere around 190 million from our reserves. And the difference in the scenario stress test 1 and 2 is depending on the level we're hedged at. If we're less hedged and prices drop, we kind of benefit from the fact that our power procurement costs will be lower. So that's a big draw on our reserves. And just for reference, today our reserve is somewhere around $160 million based on the last, as of the end of the fiscal year in 2021, end of September 2021. So we could be running into we could be running out of cash and reserves in liquid assets if the stress test event were to occur. Any question on this?
I have one more on this one. This is Rob. So when we talk about hedging, to me, sometimes that sounds like we bought an option to purchase at a certain price, but in fact, they weren't really, because an option says you don't have to purchase, right? What we actually did is we purchased and are obligated to buy at a certain price. And so if the costs go way down, we're now stuck buying well above the value of the power. Kind of thing. So that's where we really lose a lot of it. And of course, the PCIA goes up on us also because PG&E's needs to be made whole. So we get a double whammy, right? That's where most of this loss is coming from.
Yeah, our hedge is a fixed price hedge that is board authorized mechanism. We're not authorized to trade in options now. Something we will look into for some extreme events in the future. But right now we lock in a fixed price. So we're obligated at that price. Once we lock it in, we have certainty on our rate cost because we know what we're going to be paid. So we reduce risk because we've eliminated uncertainty from our power supply costs, but we also forego the opportunity to participate on the downside if prices were to go lower.
And that begs the question whether we should be talking about dialing, since prices are historically high, twice last year, should we maybe be dialing back at our hedge level? Right now, I think we're at about 80%, I think it says somewhere, and that's why we see the cost only being 219 instead of 251 is that 80% factor. But should we be considering dialing back our hedge percent level? And the company we're working with, I'm forgetting the name, that
Ascend.
does a lot of the Ascend, yeah. Their model should be starting to tell us, hey, you should dial back for less risk, maybe, right? Because this is a huge risk number right now.
Yes, I'm going to touch on this very important point in the next slide. There are some considerations if we change our hedging strategy and accounting for PCIA and PG&E gen rate increases. And I'll talk about that because these are correlated events and we've been tracking that. We actually started using NewGen's model to forecast generation rate and PCIA. So we're taking that into account, but there are bigger implications if we change our hedging strategy and we need to go through the board on what all those implications are.
And I see Larry has a question before we move on.
Yes, so very quickly, it would be good to track what our reserves have been over the last few years as part of this presentation when it goes to the full board. For somebody who's only been active for the year, that would actually help out. And I understand that that's board decision, executive board decision at the end of the day, but it would kind of help, not just projecting what our net is going into the reserves, but how that kind of how that compares to previous years. And then the other question is from a CPUC standpoint, when will they make those decisions as far as PG&E's requests?
Yes, good points. PG&E at the CPUC will meet on December 16th. That's their last meeting. I hope I have the date correct. I think it's December 16th. That's when they will decide whether they approve the rates or do something different. You know, the concern we have is these are very large rate increases. And if I were PG&E, I'd be concerned about how my customers would react to this rate increase. The CPUC would be concerned. So we have to plan for a scenario where the PUC may not act on this request or may approve not the full
Partially.
rate increase, and they may do something different. They may, for example, amortize it over a period of time. So that's something we need to be prepared for. I'm going to talk about that towards the end of this slide,
Okay.
end of the presentation.
Okay, thank you.
Okay, we'll go to the next slide, Kevin, please. So a question often comes up is, well, can we improve our forecast? And to a large extent, no. And as I explained, when we talk about forecasts, we are not sitting there modeling power prices. We're looking at where power is trading, where market participants are putting their money right now for power prices, for power to be delivered in 22, 23, and so on. So this is, and it's called a forward price. It's like the market, that's where the market is trading at. That's the market's current best expectation. So the biggest source of uncertainty is the market price volatility, and we can't quite get rid of it. And then as I talked about, the PCIA and gen rate calculations come from a black box. We do our best using a very good model that CalCCA provides us, the new gen model, and we update it for power prices, and then try to project what the PG&E rate would be and PCIA would be. And we're trying to implement that on an ongoing basis. We're in the process of doing that. We worked with the new gen CalCCA consultant quite a bit on this. So we're making headways on that. And the question then comes up to what Rob talked about. Do we change our hedging to account for the modeling of PCIA and gen rate? So this is something that will require a lot of discussions. As I said, we'll have to work through the implications of it on the board, with the board. If we were to do that, it would introduce a lot of volatility on our budgeting. We'd have to look at a few years out, not concentrate on 1 year's budget because of the what we call the whiplash effect. You know, power prices, for example, in 1 year could be going up and our projected contribution to reserves would be going up, but at the same time, following year, it would come back to us in the form of a lower PCIA and vice versa. So this is something we're paying attention to and trying to improve our modeling. And a lot of considerations need to go into effect as to how we change our strategy. Yeah, go ahead.
We do have a little bit of leeway in our hedging, right? We have a band, and staff has the ability to apply intelligence and say, well, at this price we should stay towards the bottom of the band, and then we're still following our strategy, right, without having to go back to the board to adjust it.
Yeah, we do have a band, and we have to have very good reasons as to why we're choosing the course of action. We want to be careful a little bit because we don't speculate on market prices. We don't take a speculative position. So we have to be careful in how we make our decisions. We try to pretty much follow the band within the reasonable time frame of the hedging strategy. So obviously, if there's disruptions in the market, that we see there's not enough liquidity, we don't just go ahead and robotically react to that. You know, that's what the band helps us with, and the layered strategy helps us with.
Okay, Director Mekachuk has a question.
Yes. In terms of revenue, it's price per unit times the number of kilowatt hours. And have you, in your modeling, do you have an elasticity of demand in there in terms of if prices go up, then people do certain things, and conversely, if prices go down? And the other, so that's one question. And the other one is, what percentage is the generation versus the generation and the transmission and distribution? So, for example, if generation rates went up double, what does that do to the overall cost per kilowatt hour that a consumer would see?
Yeah, very good questions. On the elasticity questions, we don't explicitly model elastic. Electricity demand tends to be fairly inelastic. That's why you can see power prices go up to 2,000, and most customers don't react to the power prices, although the commission, the the CAISO is working on demand response type programs to help improve that. And now we're going to time of use rates, and hopefully there'll be more of a elasticity built into it. What we do when we model the risk of our portfolio, we do account for correlation, historical correlation between price and demand. But for the most part, the modeling is not picking up any significant level of elasticity, because for the most part, demand tends to be fairly inelastic. Your other question on the gen rate. So gen rate, I had these numbers, but they're all blended together for me. If my friend Peyton is online, he can maybe jump in. I think the gen rate is a pretty significant component of the bill. It's probably somewhere around 50%, I'm gonna guess.
I think that's correct.
Yeah, but we can get those numbers.
Okay. Well, when do our customers in Santa Clara County go to time of use, 100%?
I believe most customers in June would transition to time of use rates, unless they choose to opt out of it. Then they can go back to their default tiered rate. But most customers have been defaulted to time of use rates.
I believe that you will see some elasticity of demand.
Yeah.
May not be that high, but I believe that PG&E is banking on demand being elastic, but I'm not.
Yeah, and that's the intent of CPUC and CAISO's efforts. Via demand response, via putting time of use rates. That was the whole argument about putting advanced metering in place to try to get more customer response to prices.
If I may, Brian, you are extremely difficult to hear.
Thank you. I'll adjust my microphone.
Thank you. I appreciate that. Particularly since Amrit says you have such good questions.
Everyone has good questions. These are all good questions.
I think that's it for this slide.
Yep. Next slide, please, Kevin. Okay, so now the question comes to, well, how do we manage going forward with the new projections that I've shared with you? One, which I hope the committee will seriously consider, is to hold in reserves for future black swan events. Our reserve targets are based on days cash on hand. Our minimum target is to have 120 days, target is 230, and maximum is 320 days. So the forecast where we're going to end up with fiscal year 2022, at the time when we set the budget was going to be 233 days. Then we look at the improved margins, adjusting for the loss we had last fiscal year. We had a $14 million loss. You know, that accounting for that, that adds about 78 days. So that brings our expected days cash on hand of 311 days. So remember that number, and I'll walk through some of the reserve calculations in the next slide. And if the black swan event that I showed you were to occur, the 157 to 190 million or so, that would pull about 189 to 227 days of cash on hand. So that would be a significant pull on our reserves. The other option is we can add to our programs fund, our double down strategy that Justin shared with the board, and we'll be presenting again, I think, in February. We can increase our customer discount. As I said before, our current discount is at 1% of PG&E's gen rate, and about 1% costs us about $6 million. And for the remaining fiscal year from January 22 to September 2022, it's about $4.5 million. And certainly the committee and the board can decide to do a combination of these three things. So before we go into deciding that, I want to share the impact of the stress test on our reserves calculation in the next slide.
And that, if I could ask a question, since you're going into this, you know, I had asked about modifying our hedging strategy, and I'm still a little bit worried because we've mostly been in an increasing prices climate, and our bands and everything have worked pretty well. In fact, we did well last year because we were well hedged, but we're going, you know, I keep thinking hedging should be for going up and going down. Both are opportunities to lose money. And I feel like we're tuned for going up, not tuned for going down, which is becoming more likely. But the second part of our hedge strategy, so what I'm hearing recommendation from you as you get into this is the second part of the hedge strategy is just have big reserves that we can afford to lose. So that's also part of the hedge strategy that keeps us from going bankrupt. So do you agree that's sort of part of a hedge strategy then? Are you frozen? Uh-oh. The question.
It looks like he is frozen, but you're right, Board Member Rennie. It's both, and you're exactly right. We've been focusing quite a bit on increasing prices, but also we don't hedge. We have like a laddering strategy, right? So, and that the amount we hedge for year 2 through 5 is less than 100%. So we are looking at trying to take advantage of lower prices too. So somewhere in the middle, hopefully we won't be too wrong or too right. So we're somewhere in the middle, but things like this, like the black swan events that we're having, definitely promotes the use of reserves to be part of our strategy.
And while we're waiting for Amrit to come back, maybe you have some insight. You know, we're already forecasting certain prices, but you know, immediately with the Omnicon version, oil prices immediately took a big hit, like 13% in one day. So we could rapidly see a reversal in this price forecast already before we even finish getting our plan in place. And have we thought about that?
So you're talking about prices in the short term changing. Yes, that could happen. So for the PCIA, that whole swing in PCIA is mostly correlated to the market price benchmark. And a portion of it is for the past and a portion is going forward. right? So if it comes down right now, some of the changes, the impact of that, we're not going to feel till next year. So I think that was the point Amrit was trying to make earlier about setting aside these reserves for a black swan event. It's not necessarily this year. It could be any future year that you have it, or it could be, you know, each year for the next few years could have lower prices too. So it's that's the big reason to hold it back. I'm not sure if I answered your question, Chair Rennie, but
Well, there's a part of it that hedging doesn't help us. That's the other than having reserves, and that's the PCIA squeeze, because next year prices could come down and we could be making less money and get hit with, or it comes down this year and we get hit next year with the squeeze where the PCIA goes up on us and the prices come down, and so we have less revenue in that direction. So that's one of the bigger reasons to hold reserves is something we really can't control.
yes, you're exactly right. And I know that Amrit is back, so I'll just say one more sentence and hand it back to him. You know, one of the things that we've been thinking about for a while is how we adjust our hedging strategy to take care of PCIA volatility. So that we haven't fully thought out what that would be like. But, you know, just as a high level, if we go down that path, we could have very large swings in our budget, very large swings. And that's just something that we need to both analyze and run through the risk oversight committee and the board before we get to that.
And I see Liz, Director Gibbons has a question.
I was going to make two observations. One is, as we've been going through the discussion about hedging and black swan situations in particular, I think back to the Enron situation and Governor Gray Davis, and he had to buy power. He had to make a decision to buy power at a very high price or hedge his bets and wait for the price to go down. And he made a decision to buy the power. I'm just going to say at the high point or close to it. And then without anyone's really understanding it was going to happen, Enron imploded. And the fact that they were artificially raising prices became clear and all the prices sank. So Davis actually was recalled because he made the best decision he could make, but it turned out to be a bad decision. So that's what Rob is looking at, is what's the risk of that black swan going down delta is. And, you know, I just think that whole Enron scenario is very indicative of what we're talking about here. And the other thing I was just going to make an observation on, and when we get our year-end summaries in the past, I'm pretty sure I recall that there was one line item, which was the cost of hedging. And I thought that was, if I understood it correctly, I thought that was a very informative number, because if we had gone to the market and just bought, I'm going to call day-to-day market price, it would have been this much cost. When we planned it out and purchased in advance, it was this much cost. And what was the delta? What was the cost of our risk? And if I recall, we've always ended up paying more because our hedging scenario was very high risk protective. We didn't want to run the risk of the cost of power going crazy. So I guess what I'm trying to say is, I thought, tell me if I'm remembering those numbers correctly, I thought that was always an informative number, because we don't always pay at hindsight. What I found, I think correctly, is hindsight was very informative on the value of the risk, and what all of our work and staff's work has done is protected us and how much it costs. Sometimes it saves us money, but a lot of times I think in the past, it's actually cost us money, but not as much as it could have cost us money, if I'm saying that correctly. So how
Yes.
close am I on that, Amrit?
You're very close. So that the way to think about hedging, you will always have regret. You can always look after the facts and said, I should have bought more, I should have bought less.
Right.
But what hedging does, if you think about, there's a range of prices and therefore a range of our portfolio cost, like a big distribution. What it does is it shrinks that distribution. It says, I'm going to now narrow the upside as well as I'm going to narrow the low side. Okay, so that, I'm not in an extreme case. And that's what hedging is. You're reducing risk. But the challenge here is how do we compute for that and account for that risk in light of the black box of PCIA and PG&E generation rates. So that adds a level of challenge to the way we manage our portfolio.
Are you finished, Liz?
Yes, fine.
I wanted to add one other thought. I'm always trying to think a couple steps ahead. And it occurs to me that the canary in the coal mine for our business, and maybe it should be the canary in the gas mine, but what is the investment level in the frackers? Because right now I think natural gas prices are high because people are not willing to put capital into the frackers right now. If we start seeing large capital going back in the frackers, that's an indication that I don't know what the delta is. 6 months later, we should start seeing rising gas production and prices coming down. If you look and you say we're still historically low in investment in fracking, then it's likely that there isn't any relief from much relief from gas prices coming. I know we don't want to make decisions necessarily on that, but I think it helps to inform us a little bit, to one indicator to look at that's a few steps ahead.
Yeah, those are all good, valid points. And we would expect that the market takes all that information and bakes it into the price we're seeing where the market is trading at. And so what we in our modeling, we use the market price because we think where the market is trading at is the best indicator right now. But we do pay attention to developments in markets for potential disruptions, and in particular for modeling stress cases. What if certain things were to happen, exactly what you're talking about, that could lead to a collapse in prices? What if that were to happen? How would our portfolio withstand such an event? And that's what the stress test does. It says, well, you can be pulling 190 million. And right now we're sitting on 160 million of liquid reserves.
Okay, I guess we're ready for the next slide.
Yeah.
Thank you.
Okay, so what this slide, as we think about how should we make a decision on what our level of expenditure should be based on the revised margins I shared with you guys. So what we said is, well, let's look at calendar year 2023, where we did the stress test on. We said end of fiscal year 2022, the forecast is to be 311. We'll still have improved margins from October to December based on if the PUC approves the AET rates. So that will bring us from 311 to 348 days of cash on reserve. But the draw on reserves is a stressful event would occur that we modeled. Would be in the first line, it would take 227 days cash on hand, leaving us with 121 days. And we're saying we don't want to fall below at least our minimum target of 120 days. So that leaves us about 1 day, which in dollar terms is almost equivalent to $1 million. Okay. Then in the lower case, we looked at where we're less hedged case scenario, stress test scenario. It would pull about 189 days of cash on reserve, leaving us with 159 days. And that's 39 days in excess of 120 days of minimum where we want. We don't want to dip below even in a stressful event, in a stressful year. So that's how we come up with a range. We're recommending that the board consider the maximum spend. Again, the key emphasis on the word maximum here, to be within the range of 1 to 32 million, based on this stress test analysis. Okay, and at the bottom, there's some other points to keep in your mind, which is that, you know, if the stress events were to occur, the board will always have the option, the undesirable option of raising our rates, where we would potentially become quite uncompetitive with PG&E. And on an forward-looking basis, PCIA, our impact to PCIA should start coming down as PG&E continues to recover its stranded costs. Any questions on this slide? Okay, we'll go to the next slide. So based on the previous slide's range of 1 to 32 million, we as staff felt recommending that the board limit its spend or consider spending an additional 20 million. The executive committee at the November 17th meeting, they reached a consensus and agreed to spend with staff to spend 20 million from the budget. As I mentioned earlier, in deciding how much to spend on customer discount, how much to spend on programs, they decided to leave that discussion for the board meeting next week. And the table here, I'm showing you, you know, some scenarios in allocating the 20 million. So if we take all 20 millions and put it into our programs, decarbonization, or what we're calling the double down strategy, that means we can keep the existing 1% discount. But if we were to increase that 1% discount for the current fiscal year, which would be in effect from January through December, that would be pull of about another 4.5 million, leaving about 15.5 million for programs. If we were to go to a 3% discount, it would leave 11 million for the programs. And again, the key thing about the programs is the expenditure programs has sufficient money right now to continue with its programs. This would be for the additional double down strategy, which would occur over 3 to 5 year period. And that's also an extra cushion that we considered, that in the event that a stressful event were to occur, the board can always you know, decide to change the strategy on funding for programs. So this is where we're asking the committees to, you know, what the committee wants to consider in terms of, one, the level of any additional expenditure and how to allocate that expenditure.
Question, Liz has a question. I'll just ask mine real quick. What does 1% equal for a average residential customer, right? If we go from 1% to 2%, is it $10 a month difference that they'll see?
It's not that much. 1% in a month is about 75 cents or so, so around $9 a year. So each percent.
Wow. Okay.
Yeah.
They'll never notice it, basically. All right.
And that's for the average residential customer.
Yeah, that was the question. Director Gibbons?
Thank you. Amrit, would you go back to the very first slide?
Kevin, please.
Amrit via Kevin. Okay, whoop. Back one more. There we go. So I would offer this as a thought. I thought your introduction of these pieces made a lot of sense, and it was well done. I think it's missing one thing, which is the premise that given the new information from PG&E regarding PCIA, Silicon Valley Clean Energy has the potential for a margin windfall. And I'm going to be explaining how that margin windfall develops and we're going to be asking the board to approve how to spend or not spend that windfall.
Perfect. Yep.
To me, that's really when you get to the very last slide and you say recommend for board approval, you're actually saying, you're asking the board to spend a portion of the windfall. And the portion can be distributed for doubling down on programs or discounts. But most importantly, the reserves are held high because of the potential for, as Rob, I think, said, an inverse black swan where the cost of energy goes way down. So I
Yep.
would find that helpful for as a board member. Okay, this is why we're doing this.
Mhm.
Thanks.
Thank you. Yep. Good point.
So you're looking for now comments kind of about,
Yes, if we go back to that slide, Kevin, you know,
I would just start, my comment would be, I'm a founding board member, and back when we started this, the goal was, a bunch of us got together and said, how do we make a dent in climate change, right? I really felt like the purpose of this organization was to fight climate. And of course, a part of that, we need to make sure we stay financially sound. But particularly if the customer is barely going to see a difference, I would say keep it at 1%, keep a lot in reserve, because, we've always been able to say we're doing all of this and we're still cheaper than PG&E. I think that's an important argument, because people that don't believe in climate change, you can easily say, well, okay, I know you don't want to spend money on this, but we're actually giving it to you cheaper. We're just turning our profits that normally would go to shareholders, we're turning it back into programs to help the environment. So again, I would argue that we should go with the 1% and go with the larger allocation for our climate change fighting programs.
yeah. Kevin, if you could go back a couple of slides, please.
I think it was 12, probably.
Yeah.
Anybody other comments on this one? I feel strongly we should be, putting the most into climate programs we can. Director Mekachek?
Yes, I have, my first question is, what's the probability of us losing customers now? Like what's happening to our customer base? Is it, I think it's pretty stable. That's, so my question is, Amrit, what's happening with our customers?
So customer base is pretty stable. Like you said, our participation rate, I think, is somewhere around 95%. So opt-out rates are very low. In fact, probably one of the lowest in the CCA community.
Okay, so if that's the case, I would concur with Chair Rennie and say, let's keep our 1%. So that second row and third row, to me, are not really alternatives. And then I look at the 20 million and I say, okay, I do believe that we should help our customers make fundamental structural changes in the demand for electricity by, on one hand, by increasing the demand, by reducing the use of carbon-based fuels, fossil fuels, and also by reducing their amount of electricity, full stop. So, but at this point in time, to me, if you go back to slide 6 and look at that second bullet point, that's where the big unknown is to me. And I think Chair Rennie referred to that as well, saying, you know, the sword could cut both ways, and something could come back and bite us in the future. So rather than increasing our program spend by 20 million, I'm wondering, are there some investments that we within SVCE could make that are a fraction of that will help us improve our operations? For example, in technology, and I think we're doing that to become better at forecasting, become better at hedging and fine tune those things that we believe that A, we're in control of, and B, will provide us with a rate of return. Because I think we can always increase our program spending. So those are a couple of my thoughts. Then I've got another question, and I know that in some public agencies you're forbidden from, quote, making money. Do we have any limits as to how much we can, quote, make? And then a follow-on to that is, would we have an optics problem if our reserves are getting too high? And then continuing on, maybe our days cash on hand is too low, and maybe it's time to increase that a bit. But notwithstanding that, by taking this money into reserves, we're just getting to where we want to be faster. So there's a lot in there, and I'll let you unpack it. And I'll also note that Director Martinez Beltran has joined the meeting.
Thank you. I did not see that. Hi. So Amrit, did you want to take a swing at any of those questions?
So I think those are all excellent suggestions. It really is up to the committee to make recommendation. I will make some points on investing in our operations. We are actually doing that in our budget. We set aside close to $1 million for what we're calling business process optimization, where we're exactly looking at, and we can go into more details on that program, where we're actually trying to implement enterprise-wide systems that are standard for our type of business. You know, how to manage the front office, middle office, back office operations more effectively and efficiently. We're still pretty much in a startup mode. We're trying to become into a more mature phase. And so part of that is what we've budgeted to do already in the budget that's already baked in there. And of course, the challenge always with a small organization is the bandwidth to implement those changes. So those are some of the things we have to take into consideration. And in terms of reserves target, we did up the reserve target at the last budget. We can continue to look at our reserves target. And what I'm thinking, is still in the thinking phase, is we do stress test type scenarios and look at what are some of the potential bad stressful events that could occur, and accordingly adjust our reserves target to be able to withstand some of those stress test conditions. So if our upper target, for example, we set it 320 days, if we find a stress test event requires drawing more, and we need to increase the 320, that we also reconsider that at the time we set the budget, and we relook at the time of we set the budget, our reserves targets. And also when we do a 5-year projection, the last 5-year projection we shared with the board, we also baked in about 55 million of cushion for uncertainty as well in our forecast. So those are some of the ways in which we're working on some of the points you mentioned, Brian.
If I could tag on to, I think one of the things that Director Mekachek asked about was, can we do maybe some kind of one-time investments to improve our ability to forecast so that our reserves don't need to be as high? I see our operating expenses are at 22 million. So it's good to improve our processes and maybe improve 10%. And, that's worth 2 million, but we're talking about swings of tens and 20s and 30s millions of dollars, 40 millions of dollars potentially. We could, and so we're now talking about holding huge reserves, well more than the 2 million a year we might save, for example, in operations. If we could is there a way, I think the question, is there investments that could help us reduce the size of the reserves we need to hold? Because we could then maybe spend 30, 40 million dollars on programs by spending 1 or 2 million now on a one-time investment that allows us to reduce the size of the reserves. I think that's what I heard in one of his questions that you didn't answer. And maybe the answer is you don't have any idea, but that it's worth thinking about.
No, thank you, Rob, for bringing that up again. Very good points. So one, I want to go back to the discussion we had in the slide. Can we improve our forecast? As I said, to a large extent, no, because the type of volatility we're talking about that we're seeing in the market is market driven. Even the best of the Wall Street could not foresee that, because they were trading power at $34 close to a year ago, and now if they had just waited, they would be selling that power to us at $67. So to a large extent, no, but the type of investment that I'm talking about in operations is not just efficiency, it's actually how to better manage our portfolio. So it is talking very much about what Brian is talking about, which is we can have mishaps in, for example, we have a lot of data that we do in spreadsheet processes. We can make mistakes in spreadsheets that are easy to make. There are standard processes in which risk management methodologies of how you capture portfolio data, how you analyze that data, and that gets into better modeling. Again, it's not going to eliminate the market uncertainty, but it's going to eliminate modeling errors that can be very, very costly to us. So it is those type of investments we're talking about.
So since our power supply expenses are almost 300 million, then a 10% reduction there could be really significant.
Yes, what we want to do is make sure we don't make modeling errors. We don't make errors, for example, insight where we don't have the right insights to making optimal decisions. But in terms of, we won't be able to eliminate market uncertainty. That's a big part of what drives the numbers.
Let me go to Director Klein, who has a question.
Yeah, so I just wanted to say I agree with Chair Rennie that staying with the 1% at least for now makes total sense, and conceivably, and it's a minimal effect, although some residents of course would say that $9 is $9 or $10 is $10, but I do think that it makes sense to keep that 1% at least for now, and we reevaluate for a year from now. As far as reserves, I do think that continually evaluating that on what our reserves are and how the market plays, I do think that's something that we need to look at in long term of what's the right number of days that we have in reserve. And that's all kind of a fluctuation, exactly what you just said. As far as modeling, you don't really know, because things kind of do fluctuate. Certain portions of this will fluctuate, and we lock in and try to hedge our bets as much as possible, but there is still some flexibility there. So I totally understand. I think where we stand today is relatively good, depending upon, of course, what the CPUC says. Keeping that 1% discount will keep customers there. We can always point to that for whatever value, for whatever energy we were providing, we are, maintaining the environmental benefits of utilizing that 1% utilizing any profits that we have towards beneficial programs, which I think most customers would at least be in favor of. And I think reevaluating either both what our reserves are and then what we utilize, what programs we continue to optimize or prioritize. And then finally, are there benefits in investing in other ways of utilizing those reserves, not just putting that money into programs, but making sure that we are saving those reserves into other funds accordingly. That's a whole other thing. But I think that what, from a plan standpoint that we have in front of us, I think, the 1% and then just keep evaluating makes the best of sense. And hopefully the CPUC makes something in accordance to what we expect, but who knows when we get to that date in December. Thank you.
And I see Chief Executive Balachandran, I think, wants to respond.
Yep, thank you. I wanted to go back to Director Mekachik had one additional question about optics, and there's an optics problem and whether there could be maybe some risk to raising our rates to a certain point. I think those are both excellent points. Yes, there could be an optics problem. And from a legal standpoint, there's always a potential that someone could use Proposition 26, which those of you who have water, other utilities, you have Prop 218 and Prop 26 is also an issue. So that may be an item that gets considered in closed session too, in terms of those risks. But at this point, if there's a purpose for using the money, I think we should be okay. But it is something that we should keep an eye on, Director Mekachik. As far as the optics problem, I think that's also, part of the recommendations that we have are, we don't want to be higher than PG&E. So if the PUC does not approve the rate in time, there may be a short period of time that our rates are higher, but then we'll adjust it. But I do think there's a risk that PG&E is going to be under fire. We don't know, but because it's a very high rate increase when you combine T&D rate increases too. So from a customer standpoint, that's going to be hitting them. If I may just offer up another kind of thing, we're looking for a recommendation for December 8th. And I think there's some very good suggestions on additional things we need to be doing going forward in the next, 2 quarters. Things like looking at our reserves again, as the DCA, as the days cash in hand may be too low. So those could be things that we look at before the end of the current fiscal year and bring it back to the board.
Director Gibbons?
Thank you. So I appreciate the conversation that we've just been having on what we're being asked to recommend to the board. So first off, in the past, in March, sometimes in the past, there's been a change with PG&E. And I think it had a lot to do with PG&E not being settled by December. But is there any risk other than the PUC CPUC not accepting what they're proposing? Are we anticipating anything changing in March? So we have to make yet another rate change?
Not that I know of. I think generally they do have another rate change in March, and they tend to update their transmission and distribution rates at that time. If they have any pending issue from generation, they could update that. But I'm not at this point aware of any anticipated generation changes.
It has happened in the past.
Yes.
So in terms of the 1%, 2%, 3%, I do think optics is a very valid topic. optics for the reserves amount, I think is a concern, but I appreciated Garisha's just comment. The thing is, PG&E's rates are going way up. I mean, it is a big hit. So is there and I mean this strictly, is there a marketing benefit for us as a CCA to have a more, I know it's not much in dollar terms, but in terms of percentage, is it, and we've done it before, we've had 3 and 4% lower than PG&E. Is it a good thing in terms of market optics, customer optics, that we can say we are substantively less, we're 4% less than PG&E because we're well managed? That kind of thing. I don't think we should underestimate the value of that. Our bills are not easy to read. People complain to me a lot about that. And, you know, I just always say 1% is 1%. But does anybody have any thoughts about the value, the optics, the value of not being to try and respond to the magnitude of the PG&E increase, even if it's just a numerical 3%, because we're better managed, better and doing a better job for the climate than PG&E. Anybody have any thoughts on that?
You asking the committee or?
Yes, I'm
staff
asking. I'm
too?
asking everybody. There
Okay.
seems to be a consensus at 1%, and oversimplified, I'd be okay with the 1%. But I just want to ask the devil's advocate question: is there an added way of looking at this decision?
So I think maybe when you think about the tens of thousands of customers we have and what our mission is, maybe a few people may feel good about it, but I think in terms of actually leveraging our mission, I guess I come from a standpoint of having the money in our reserves to be used for additional risk management, so these black swan events, and also leveraging decarbonization efforts, doesn't take away that option in the coming quarters to the coming years. We can always go forward with an additional discount, but we are still very new. In our history, we've never had this kind of price rise. So I think the board would preserve optionality by holding on to the money now. It doesn't preclude having additional rate decreases later on. So from a marketing standpoint, I don't think it makes a difference between 1% or 2%. It does make a difference if you go from -1% to higher than PG&E, right? So I think that's where you'll actually see a customer impact. And we've seen that with at least a few other CCAs. So we have experience with those who are higher than PG&E, how it impacts their participation rate. Those are my thoughts.
Thank you for that. I just wanted to play devil's advocate just a little bit to make sure that we're okay. But I also think your last point is something that should be actually said, which is going forward, as we learn more, as our modeling becomes more efficient, blah, 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 we do always have the opportunity to further reduce the discount. I think that's an important point. Thanks.
Okay, I'll go to Director Martinez Beltran.
Thank you, Chair. Hello, all. I'm glad you asked it, Director Gibbons. I think that it is a valid point to consider. I think that it maybe is less important because of where we're at and where everybody's at, having gone through the pandemic, and that we're still standing where we're standing in a very healthy position. And so I think, having said that, And what our executive director just said, that you repeated, that we do have the option to change it later, but letting people know we've made it through here. We're still in a healthy place. We're strong. And we're going to, because we don't know still that we're in calm waters and all of this, which we don't. I think this is a good place for us to be. And we will reevaluate as we're able to. And I think that's where I feel most comfortable with us staying. Although I don't have the longevity that some of you do have on the board, I'm really grateful to the structure that's been set up thus far. And I think we're doing exceptionally well. So that's my 2 cents.
Thank you, Director Mekachuk.
Yes, this is a question for Garish. How fast can we drop our rates if PG&E doesn't raise their rates such that we cost more than them? So that's one, how fast can we do it? And then the other thing is, can we give an undertaking to our customers that we will be 1% less than PG&E, and if we're more for a couple or 3 months, then we will then refund them that money.
And we've done that in the past, I think, kind of.
So Director Mekachuk, were you listening in on one of our internal conversations? You must have. So I'm going to hand it over to Amrit because we were thinking of potential questions and scenarios.
Yeah.
So Amrit, go ahead.
So let me go to slide 14, I think. So what we're asking as was just mentioned, we don't know what the action the CPUC will take, right? So we're basing rates off of the rates we have based on what PG&E filed in November. So right now we're saying, I'll go back to a previous slide when we talk about budget, but we're agreeing on a discount, like everyone is agreeing on a 1%. So we'd say provide a 1% discount to PG&E generation rates effective January 1. Provided that the PUC does not delay the AET increase. So if the PUC come December 16, we find out the PUC says, I'm not moving forward at all with the rate increase. We don't want to do anything. We will hold on. We will say rates stay in place until we meet with the board and concur with the board at the January 12th meeting. But let's say we go with the PUC does take some action. Let's say it approves the AET rate as we've contemplated, then we would have a 1% discount, would transfer 20 million to programs fund. But there could be some discrepancy in actual rates and file rates, AET rates and file rates, and we will make that adjustment in February 1, where we'll go back to the board and say, here are the revisions to February 1 based on the actual adopted AET rates, but no strategy change. But in the event, let's say the PUC takes some action that's in between. It says, I'm going to approve the generation rate PCI, but not to the extent that PG&E is asking for. But something we're saying, if it results in 10% on average or lower than the expected rate based on the November AET filing, what SVCE rates would have been, if it would have been lower by 10% or more, then we will, even though we've based the rates January 1 off of the AET filing, which is what we got the board approval for, we will immediately readjust the rates to a 1% discount, but it may take us about 3 weeks in January. And the reason for that is we still have to go to our billing agent, Calpine, and go through all the calculations and for them to make all the changes in the bill, in the billing engine, which every other CCA will be doing. So we're asking for 3 weeks. And then we're saying we do not transfer any additional funds to programs because there's no urgency in that, because programs still has sufficient funding and we can revisit any additional funding at the mid-year budget. And then we revisit the discount at the January 12th board meeting. We can come back and say, okay, do we want to change anything? and implement anything else. But we would, so bottom line is if the AET is approved in substantial form as is, we'd go with a 1% discount. But sounds like even if the PUC approves a rate that doesn't result in as high of a rate for PG&E, or the PCI doesn't decrease as much, we will still obviously continue to provide 1% discount, but we will, within 3 weeks in January, adjust the rates to be reflective of the 1% and whatever the true up any over collection that Brian mentioned. So we would have over collected a little bit from, let's say, 1st of January to when the rates go in place around middle of January. We will true that up in future discounts. So 1% would become 1 point something more.
So that was Director Mekachek, you asked that, right? So I'll let you follow up.
Yes, thank you. So on this slide, are 1, 2, and 3 combined, or are they mutually exclusive, or are they? Maybe I don't understand.
Yeah, so this is a confusing slide, and I apologize whether this is 2 minutes into the meeting we were updating this. So one, I want to revisit the budget. And let me just very quickly do that in a previous slide. And the reason I want to revisit the budget, not just to adjust the revenues for the discount, but because our power supply expenses are up 20 million, if you recall, I mentioned. So Kevin, if you go to slide 13, please. If you look at the middle line power supply expense, that's a 7% variance. If you remember, the board, when they adopted the revised budget policy in September, there was a 10% threshold trigger. And I'm concerned we may hit that trigger, and I'll have to come back to the board. So I'm informing the board right now, we are on a projected basis on our expenditure on power supply as of now is 20 million over. So readjust that line. And then obviously we will adjust the revenue line based on whatever the discount is. And in this illustrative budget projection, I put the entire 20 million, which is what the committee's recommendation is, of additional expenditure to programs. So that's, so on a forecast basis, our available for reserves would be about 88.5 million as opposed to 109 million. Okay, so that's one recommendation. Let's go back to slide 14, Kevin.
Sorry,
So,
if I may, sorry,
yeah.
Can I just clarify through the chair? You would reset the budget and we would reset the 10% going forward.
And track that for the rest of the year, right?
Correct.
Thank you.
I was going to ask that too. Good job, Liz.
Yeah, so because we may hit the 10% and then we'll be out of compliance. So that's the first part I'm asking, adjust the budget. The first line is to adjust the revenues, which we would normally do anyway because of the change in the discount rate and the new projections. Second is the power supply expense. Third is the transfer of the 20 million to the programs fund. The second is just asking the board explicitly now to authorize rate changes for our customers. So this is to say, on January 1, we will adopt rates that is 1% discount to PG&E's generation rate based on the PG&E's November AET filing. Okay, and then the sub-bullet there just says, there may be discrepancy between AET filing that's not substantial, but there's always some true-ups later on. We will come back, as we've done in the past in February, through a consent item, file the new adopted AET rates based on the actual approved AET rates from the December 16 CPUC meeting. The third says, well, what if the CPUC doesn't approve the AET as PG&E has filed it in November and it does something else? It says, I'm going to defer The first two item also said if the CPUC says I'm not going to take any action, then we don't adjust rates. So it's provided CPUC does not delay AET rate increase. So that's also an important point. If the PUC says I'm going to defer this decision to a future meeting, we're not going to take any rate change action. The third item says the PUC does take some action. It doesn't approve the AET rates as filed, but it doesn't approve rates, but it still increases rates quite a bit, but not as much as the November AET filing would have raised them. We're saying if it's within, if our rates otherwise would have been 10% lower than what we've implemented, we will do another rate implementation immediately. We will ask Calpine, hey, model your rates, 1% discount to what the PUC approved. So that we don't, and then we would have over collected slightly relative to our 1% target to the PG&E's rates. We will refund that. So subsequent rates will be 1 point something percent. Okay, so that's the sequence of events there.
Let me check. Yvonne, your hand's been up. Is that from last time, or did you want to ask? I guess came down. Okay, Director Mekchuk.
Okay, I think I understand this, and why don't I just say kind of where I am on this, and you can plug it in as appropriate. I think we should keep the 1% discount. So, and I don't think we should transfer any additional funds to the programs fund at this point in time. So that's kind of where I am. And then, so in 2, I think we should always have, we should, wherever we are, I think we should have a 1% discount. And if we over collect, we should then refund that to our customers. So that's kind of 2 and 3. And I like the line in item 3, the second bullet, do not transfer additional funds to programs, revisit funding or programs at mid-year budget. I kind of like that one, and I don't think we necessarily need to revisit the customer discount, because if as a policy, I think we should have it at 1% for the foreseeable future at 1% less than PG&E rates. And I think that our service provider on the billing side should be prepared to make these adjustments both now and in the future if they have to go up, or if PG&E rates stay the same or go down. So that's kind of where I am. But I don't think we should increase our programs funding until we're more certain as to where we are. And when Chair Rennie clarified my observations or my comments, where I said, if there's a way internally that if we spend more money or accelerate our spend so that we become, so that we can buy power at a lower cost, then, or at a less risk of what our margin is going to be, we should do that, because that will have a multiple return versus putting that $2 million or $1 million into a program spend. And I think while the program spend is a good thing, it's got a lag, and it's also got less than 100%. There's a risk factor to it. So, and finally, I've found in my experience, it's a lot easier to increase your spending than it is to cut your spending, and it's harder to increase your rates than decrease your rates. So that's a little my.
Can I consider that a motion?
Absolutely.
Director Gibbons?
Okay, thank you. I look at this a bit differently than Director Makachuk on this item. I do understand, and staff, please correct me if I'm wrong, that staff has already acknowledged, planned for, and the budget has already supported optimizing processes, which is specifically set up to do whatever is possible to improve the ability to project and purchase power at the lowest price. I believe staff's already doing that through the budget of optimizing processes. Is that correct?
That is correct. We have about close to 900,000, close to $1 million
Right.
budgeted for this fiscal year, and then we will ask for additional funding for future
Next year. Okay, so I'm comfortable that your point is very valid and already being addressed. Second point is that I'm reading this 1, 2, and 3 a little bit differently. I think there are triggers to 1, 2, and 3. The first is as part of our normal budget update and our normal rate adjustment that we do at this time of year because of the way PG&E's numbers come out. I am okay to provide a 1% discount. And I'm okay with the $20 million to change into program funds because of the analysis of staff's stress tests. I thought the stress test showed a big range, and it came down to a worst case, best case, the 1 million to 39 million, if memory serves. And
32. 32.
Okay. 32. And we settled on the 20 million, and I'm okay with that. So I'm supporting option 1. Option 2 is if 1 doesn't take place, if the CPUC doesn't act, then we are authorizing, the board would authorize staff to do what it says in item number 2. If that doesn't happen, then we are going to take authorize staff to do item number 3. That's how I'm reading it. It's 1 or 2 or 3, depending on the triggers that happen basically by the CPUC.
So,
Am I right?
yeah, I apologize for the confusing slide. So 1 and 2 are actually the same thing. I'm
Okay.
just being explicit. 1 is to adopt a revised budget, and 2 is to make the rate change. Ask the board explicitly to authorize us to revise our customer rate. So they're the same thing. If the PUC doesn't delay, based on the discussion, the committee is recommending a 1% discount. 3 says, but we will, the key here is in 1 and 2, we're going to base rates because it takes 3 weeks for Calpine to be ready to bill our customers. We don't want to wait after CPUC decision, because in case the likely scenario happens and the PUC approves the AT rate increase, we would be losing significant amount of money because our rates are very low relative to what they would be with a 1% discount. So we want to base rates off of the November AET filing, get Calpine going right now to model the rate changes. Come January 1, we can hit the trigger. We're ready. Our rates are in place. But then there's the uncertainty of what action the PUC will take on the 16th.
Right.
So we're saying one thing is, it's very easy to halt the implementation if the PUC, for example, didn't do anything. They said by anything, meaning they didn't authorize any rate increase. Then we would obviously stay with our current rates because those would still be effective. But if the CPUC took an action that resulted in SVCE rates that would have been 10% lower than what we have in, then we're saying we're going to pull the trigger and do another immediate rate increase. And that would likely be within 3 weeks of January.
So-
And then we would have over collected a bit.
Right, and then you adjust down. So,
Exactly.
right, so may I suggest, when you get to the board, revise this slide to say something along the lines of, this is the budget update, and it has the normal update, and one is related to the increased cost of power, and two is the rate adjustment relative to the PG&E filing with the CPUC, whatever, blah, 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 blah. And then the third is to make these program changes as a result of the black swan situation where the value of power has gone up, that we have a windfall, and that the recommendation is based on the risk of an inverse black swan. So I'm trying to say, if you can summarize it to say, this is what we normally do for the budget adjustment, this is what we normally do for the rate. This is a unique situation because of the black swan pricing, and the resulting in that is a stress test and extra funding. And then the second bullet point is, if the PUC doesn't do this by this time, okay, so there'll be a third item under normal, which is to authorize the rate increases to go into effect January 1st. And then the second option is, if none of the above happens, this is what we would do. Can you simplify it like that?
I'm going to give it my best shot.
I think I've said it reasonably close to what I'm thinking, but at any rate, you, as you well know, this needs to be simpler for the board.
Yes.
And so Liz, I would take that as you're not going to second the motion.
I am not seconding the motion.
Director Klein.
Yeah, I had a question based upon something the vice chair mentioned, and I'm just trying to figure out logistics. Is it even feasible? But one of the things that the vice chair talked about was refunding, and I'm not in favor of that for logistically as we adjust rates and do all of that. But hypothetically, how difficult is that from an organizational standpoint to say, oh, the board decided that we're going to refund some percentage of the last quarter or the last few months because we have conceivably over collected, and we're trying to do the best thing from a fiduciary standpoint as possible, as opposed to just moving it to reserves for the rainy day for the black swan event. So I'm just trying to get a better idea. I'm assuming we haven't up to this point done it, and I'm just trying to figure out how difficult it would be as our billing system is currently set up.
Yeah, so one point on just want to be clear, and maybe this isn't that needs clarity, but when we say we're gonna true up, we're not gonna go back and redo any rates. It's just forward looking, right? Yeah, okay. So we would just adjust the rates going forward. So 1%, 1 point something.
Correct, but the vice chair was actually talking about refunding, not just true up future rates. And it's like, oh, it's as if we overcharge, and I wouldn't think that we would ever do that. That being said,
No,
is it logistically even possible?
No, it's just the way we were just for our discussion as to what that extra 1 point something is.
Just clarify that.
I fully intended to follow the first sub-bullet under number 3, readjust rates. Readjust rates to provide a 1% to the AET approved PG&E generation rates. True up any over collection that resulted within the first few weeks of January.
Okay, thank you very much. I just through your questioning, you talked about refund, and I had not seen that mentioned previously, and was just being relatively new to this. had wondered if we'd ever did that or had that even been envisioned. So I totally agree behind the true up. It makes total sense. Thank you.
And are you interested in seconding his motion, which has no money transferred to the programs fund?
Yes, I would be willing to second that.
Okay. At this time, let me open it up to our attendees for, which I see is a board alternate, for any questions or comments if she's interested. If she's still awake. That's all right. I don't see any hands going up, so we'll close public comment and Director Makachek.
I was going to say, Mike Mayer may want to make some comments and what he sees in the landscape across other CCAs that he works with.
I was this close to just leaving the meeting and call me in. Yeah, I mean, it's an interesting conversation. It's a good conversation that we're talking about numbers going in this direction, at least in the short term. I think certainly a lot of those CCAs are going to have this situation that they're going to go through. I don't know exactly where they're at with their decisions on how they're going to set their rates, so I won't comment on that specifically. I think the only thing I'll comment on is the question as to sending money over to the programs. I think, and Amr can maybe clarify some of the specifics, but when I think of the accounting and some of the outward facing documents, I always think of two different thought processes. One is, how are we accounting for everything on our full accrual accounting? So this is the financial statements that get audited. This is different than the budget. So the main GAAP financials does not consider program reserves or other reserves. It just is going to show this cash item and unrestricted net position. So there's an important distinction there with what may be the public sees or what we give to different suppliers. They're going to see the cash regardless of whether we send it and earmark it for programs or earmark it for reserves. So the bottom line is going to be unaffected by this transfer to the programs. Now that said, the public and the board does have a lot of focus and interest on the budget. So this movement of the programs does affect the budget, but it doesn't constitute an actual expense at that point. So it doesn't decrease the bottom line. So I just kind of, that's just one thing I was thinking of when we're talking about this, is it doesn't, as far as we talk about optics, does the public care that we're making this much money in this particular year? Well, that transfer doesn't really affect that. That's just a budget item. And it would only be a decrease in your bottom line, a decrease in your net position at the point in which it's actually spent, not transferred. So I think that was the only thing that really stood out that I wanted to mention.
Director Martinez Beltran.
Thank you, Chair. I think you were talking to me just a bit ago, but I just wanted to, make sure that so I understand we've got the two motions then on the floor.
There's
right?
only one motion, and that's, basically Liz says she's not supporting the motion because she'd prefer to transfer the 20 million to the programs fund. The current motion is 1% with no transfer to the programs fund, and we have a second on that so far. So two people potentially interested in voting for it.
Okay, but this omits the transfer to the programs fund, this motion on the floor.
Correct.
Okay. Thank you.
Director Makachek.
We can transfer monies to the programs fund in the budget in the future. I don't, because we've got a big uncertainty with respect to what the CPUC is going to rule on this. And I would revisit that after we have certainty from the CPUC. And it's unfortunate that our budget process is not linked to the CPUC decision-making process, because we need to be, their decision impacts what we will do. But I think that if we transfer money over in the budget that we ultimately end up spending, that ultimately hits our historical financial statements, then, it's hard to dial that back. So I just think that it would be better to be a little conservative, and then we can ramp it up versus ramping it down.
And let me ask a question. So mid-year budget means March timeframe, I assume?
Yes.
And you mentioned, I think I heard you say early on that we don't need money in the fund right now. When do we need money in the fund to kind of continue our double down attack?
So I think Justin is going to provide additional overview to the board on the programs in February meeting. But Grish, you may want to add to that.
We are planning on coming back to you in February with an operational budget. I think as I'm hearing this discussion, one thought is to maybe have something like targeting $20 million to be addressed in the mid-year budget, something like that, so you can actually be specific in this motion about what we are targeting, but not actually pull the trigger on it. So that's just another piece. But when I'm thinking about doubling down strategy, I'm going with what the board, we all discussed, which is trying to make a meaningful change. We don't know what it's actually going to be. And frankly, it's going to be tough to spend that much money fast. So even if we set aside $20 million, on December 8th, just to staff up the organization, everything else, getting contractors in place, if there are policies that have to be approved by your city councils before we can actually implement things, we're talking Q4 of this year before serious money will even start to go out. Everything else just set ourselves up, we have in our budget already. So those are just some comments for Director maybe Gibbons and Mekachuk to think
So
about.
let me go back to Director Mekachuk and see if he's interested in entertaining an amendment to his motion to say targeting 20 million for the mid-year budget, but not transferring anything at this time.
That's exactly what I was thinking. Very well put.
Would Director Klein entertain?
Absolutely.
Okay, so we have a modification in the motion. That must be good enough for Director Gibbons, who put her hand down. Director Martinez Beltran, you still have your hand up. Did you have more to say?
I did. Thank you. I also really appreciate that amendment. And I wanted to know, I see that it's 3 weeks, after January 1st that we're looking to hear from the CPUC. Just before then, I guess the staff comes back to us in February. So there's no hesitation in thinking that we'll be clear on what those rates will be. That should all have been panned out by then. Is that right?
Yes, the PUC, we will know on December 16th after they're voting what course of action they're going to take. If that was the question. I'm sorry, I missed the gist of your question.
Okay, perfect. All right, thank you.
All right, I don't think I see any more hands up. On mute. I don't see any more hands up. Let me call the question. So the question on this motion is a 1%, and then to target but not transfer 20 million. And everything else on the slide, 1% for item number 2 and following all of the bullets in item number 3, I believe is the motion. So I will do a roll call vote, starting with Director Martinez Beltran,
Aye.
Director Klein,
Aye.
Director Mekachek,
Aye.
and Director Gibbons. Oh, you have comments?
I did have a question. I'm sorry.
Sure, go ahead.
Are we voting on giving staff authority that they were asking for to set up the new rates as of January 1st, et cetera?
Yes,
All of that is part of the motion.
yes.
Then I'm fine. Yes, thank you.
And you vote, so you vote yes for the motion? And I also vote yes, so it passes unanimously. I think that's the end of this agenda item, correct? And this is our only agenda item. Does anybody else have anything else they want to bring up? No? Looks like we're gonna be ending 2 minutes ahead of time. All right, so I will adjourn the meeting. Thank you, everybody. Good, robust discussion. We'll see you at the board meeting.
Thank you. Good night.
Bye-bye.
Thank you. Good night.